All right, welcome back, guys. Today we're going to be doing vocabulary for risk and return when it deals with investing. So let's go ahead and get into it. There's only 5 vocabulary words for this assignment. And of course, your instructions are to write a complete sentence using each word and then draw a picture representing each word. So the first word is bond. Bonds, like it says here, they're pretty safe investments, usually issued by governments or large corporations. Like when an example is when a government wants to build a highway, they usually issue a bond to raise money, to basically to get money to be able to build that highway. So what they do is they take money from ordinary people like you and me, and then they take that money and they use it to build whatever, like the highway, and then they pay your money back plus interest. So it's a form of investing. So if, like, say I bought a bond, so I gave $1,000. Say I gave $1,000 to the city of San Antonio, and then they paid me my $1,000 back, and then they would pay me extra depending on how much interest they're paying on that bond. So that's the way a bond works. They're pretty safe because they're usually done by governments or really big companies, big corporations. Next word is the Dow Jones Industrial Average. A lot of people just call it the Dow or the Dow Jones, and it keeps track of the stock market and how it's doing day to day, and it's made up of companies in different industries, you know, like the tech industry, the manufacturing industry, what else, like the financial industry. And then they use that information basically just to see how the stock market is doing. And it's a great way to track if the economy is doing good or bad, things like that. The next one is a mutual fund. Okay, mutual fund, it's basically a group of a pool, like it says there, a pool of stocks, bonds, and other securities managed by an investment company. So the way it works, when I used to be a banker at Chase, we used to do these a lot. We used to have mutual funds. So what a mutual fund is, it's an investment, but it's an investment in different corporations. And like it says, some bonds, some securities, some other securities. So you buy into this. And if the mutual fund does good, you make money. If it does bad, you lose money. But the idea is to diversify the risk of each stock that is put into the mutual fund. So think of it as like a pie, right? It's like you're building a pie. This section has cherries, strawberries, like all these different things. If some of these go bad, well, at least the whole pie doesn't go bad. Of course, if they all do good, well, the pie becomes better or is good. So, but in this case, it's about money, right? So you put this money into these different companies, and the idea is that if some don't do as well as others, well, it's still going to keep doing well overall. So that's the idea behind a mutual fund. A rate of return. Okay, so it's a pretty simple concept. It's usually done for the year. So the example here, it says if you invest $100, after a year you make 112, or you make $12 on that 100, then your rate of return is 12%. So again, it's pretty easy math to calculate, and it's basically the money that you get back, which leads us into what that word means, return. It's how much money you make on the money that you invest. Sometimes you do lose money though. And if you lose money, then that is called a negative return. So that's it for the vocabulary words. If you guys need help, you can always catch me in my office hours. I hope you have a great week. Thanks for watching.